Ladies and gentlemen, trading has never been about conquering the markets. It has always been about conquering yourself. Most traders enter this arena searching for the perfect strategy, the perfect setup, or the perfect moment. Yet they overlook the single element that determines their long-term destiny, their mindset. The difference between a losing trader and a consistently winning trader is not intelligence, not experience, and certainly not luck. It is a mental shift, a shift from needing certainty to embracing probability, from fearing loss to accepting it as the cost of doing business, from being emotionally attached to each outcome to simply executing an edge with discipline and confidence. When you understand that every moment in the market is unique, that no single trade defines you, and that your job is not to predict but to act on your advantage without hesitation, you step into true freedom. You rise above fear. You rise above regret. You rise above the illusions that keep most traders stuck in cycles of hope and pain. Winners aren't born. They are shaped by the mindset they choose to adopt. And the moment you decide to think like a winner, the market begins to respond to that version of you. Today is about stepping into that version. Today is about the shift that transforms everything. Consistency is a mindset, not a strategy. At first glance, this sounds like a clever trading slogan, but it is far more than that. It is a complete reframing of how a trader thinks, behaves, and interprets the market. Most traders spend years searching for the perfect indicator or the ideal combination of signals, believing that consistency is hidden somewhere inside a chart pattern or algorithmic formula. But the truth is this: the market does not reward strategies. It rewards the trader's ability to execute any chosen strategy consistently without emotional interference. And that ability comes from the mind, not the method. To understand why consistency is a mindset, one must first understand the psychological environment in which trading exists. Unlike other professions, trading offers no structure, no rules, no guaranteed outcomes, and no external authority to enforce discipline. It is an environment of complete uncertainty where anything can happen at any moment. Yet most traders step into this arena with the mindset shaped by traditional education systems based on right answers, predictable outcomes, and rewards for correctness. When a trader brings this need for certainty into the markets, they set themselves up for emotional pain. They hesitate, they fear missing out, they chase, they refuse to take losses quickly, and they can't pull the trigger when necessary. The strategy becomes inconsistent not because it is flawed, but because the trader is being driven by beliefs, fears, and expectations that have nothing to do with market reality. The foundation of consistency begins with accepting the true nature of the market. Every trade is a unique event. No pattern, signal, or setup is ever identical to the last. A trader who understands this does not burden each trade with the weight of expectation. Instead, they evaluate the market through probabilities, not certainties. Probabilistic thinking is the first pillar of a consistent mindset. It frees the trader from the emotional turbulence that comes from trying to predict or control the future. When a trader embraces the idea that any outcome can occur, they stop resisting randomness and begin to flow with it. They no longer need the market to behave in a certain way to feel safe or confident. They simply execute their edge, knowing that over a series of trades, the probabilities will play out. However, making this shift is not merely an intellectual exercise. It requires emotional alignment. Many traders can speak in probabilities, but their actions betray their underlying beliefs. They move stops because they cannot accept being wrong. They exit winners too early because they fear losing an open profit. They skip valid setups because the last loss is still haunting them. These behaviors do not reflect a flawed strategy. They reflect a mindset dominated by fear, regret, and the need for emotional comfort. Consistency cannot coexist with such internal conflict. The market punishes hesitation and indecision, not because it is cruel, but because it demands alignment between belief and action. A consistent mindset is built through internal trust. You cannot be consistent in action if you do not trust yourself to act. This trust is developed by creating rules that define how you will engage with the market and by following those rules with unwavering commitment. The rules provide structure where the market has none. They act as a psychological anchor, preventing you from drifting into impulsive decisions. But rules alone are not enough. Many traders write rules and ignore them the moment the market creates emotional discomfort. True consistency comes from honoring your rules even when your mind screams to do otherwise. It is a commitment to long-term results over momentary relief. One of the hardest psychological barriers traders face is the fear of loss. Losses are unavoidable. They are the cost of participating in the market. Yet emotionally, many traders equate loss with failure. This belief is toxic. A trader who cannot accept losses will always sabotage their consistency. They will hesitate to enter trades after a losing streak. They will avoid taking valid setups, and they will interfere with the strategy to avoid emotional pain. Consistency requires redefining what a loss means. A loss is not a reflection of personal inadequacy. It is a normal, expected outcome within a probabilistic framework. When traders detach their self-worth from individual trade outcomes, they gain the freedom to follow their edge without emotional distortion. Another essential component of a consistent mindset is neutrality. Emotional neutrality is not the absence of emotion. It is the ability to act independently of emotional impulses. Markets are designed to trigger the deepest psychological biases humans possess: fear, greed, hope, and anxiety. The inconsistent trader reacts to these emotions. The consistent trader recognizes them but does not allow them to influence action. Neutrality creates clarity. It allows the trader to see the market as it is, not as they wish it to be. This clarity leads to better decisions and, over time, consistent performance. A mindset of consistency also includes a profound understanding of randomness. Randomness does not mean chaos, it means unpredictability and short-term outcomes. A trader with a consistent mindset does not interpret a loss as the market being unfair or the strategy failing. They see it as a random distribution outcome within a larger sample size. This perspective prevents emotional overreaction and helps maintain discipline. Many traders fall into the trap of strategy hopping because they misinterpret short-term randomness as evidence of failure. They abandon strategies prematurely and chase new methods, never allowing any system to produce long-term results. A consistent mindset ends this cycle. It takes the pressure off individual trades and places emphasis on a structured, long-term approach. Discipline, of course, is a cornerstone of consistency. But discipline must be understood correctly. It is not about forcing yourself to act. It is about aligning your beliefs with market reality so that acting consistently becomes natural. When you understand the market's nature, accept risk, embrace probabilities, and detach emotionally, discipline is no longer a struggle. It becomes a byproduct of clarity. You do not need willpower to act consistently. You need the right mental framework. Once that framework is established, discipline follows effortlessly. The journey to developing a consistent mindset is deeply personal. It requires introspection, honesty, and a willingness to confront uncomfortable truths about your current beliefs. Many traders discover that their biggest obstacles are internal: fear of failure, fear of uncertainty, perfectionism, the need for control, or unresolved emotional patterns. These patterns must be addressed. Trading is a mirror that reflects everything you avoid. When you develop self-awareness, you begin to see how these patterns influence your decisions, and you gain the power to change them. Personal growth becomes part of trading growth. Consistency is also built through experience, but not just experience in the market, experience in executing your plan. Repetition creates confidence. Confidence creates ease. Ease creates flow. A trader who has executed their plan hundreds of times without deviation develops an unshakable internal foundation. They no longer question themselves in the moment. They act, they evaluate, they refine, and they grow. In the end, consistency is a mindset because the market does not change. You do. The strategy stays the same, but your relationship to it evolves. You stop fighting the market and start working with it. You stop trying to force outcomes and start allowing probabilities to unfold. You stop riding emotional highs and lows and operate from stability and neutrality. This psychological transformation is what separates those who struggle endlessly from those who achieve long-term success. A trader with a consistent mindset does not hope. They execute. They do not fear. They accept. They do not predict. They respond. They do not chase. They wait. And ultimately, they do not try to win every trade. They focus on winning over time. Consistency is not born from charts, indicators, or technology. It is born from the mind that wields them. When you shift your mindset, you shift your results. When you create internal consistency, external consistency follows. And when you master yourself, the market becomes an arena of opportunity, not danger. Consistency is a mindset, not a strategy. But once you master that mindset, any strategy in your hands has the power to create success. The market reflects probabilities, not personal beliefs. This truth sits at the core of successful trading, yet it is one of the most difficult concepts for traders to internalize. Human beings are naturally wired to interpret events through personal perspectives, through hopes, fears, expectations, and the desire for control. But the market is an impersonal environment. It has no awareness of what a trader wants, no concern for individual opinions, and no obligation to align with anyone's predictions. It moves based on a complex dynamic interplay of countless participants reacting to information, emotions, and global forces. In such an environment, personal beliefs hold no power. Only probabilities matter. Understanding this distinction marks the beginning of real transformation in a trader's mindset. Many traders enter the markets believing they can impose their will upon price, or that the market should reward their analysis. They interpret every move through the lens of what they think should happen. When price acts differently from their expectations, frustration, confusion, and emotional spirals follow. This disconnect stems from the illusion that the market operates in a logical, predictable manner aligned with personal reasoning. Yet markets are not built on logic alone. They are built on collective psychology. Even when fundamental or technical analysis points in one direction, price may move the opposite way due to factors unseen or unanticipated. It is not the market's responsibility to validate a trader's ideas. The market has its own rhythm, independent of any individual's belief. When traders finally accept that the market reflects probabilities, not personal beliefs, they free themselves from the emotional burden of trying to be right. Needing to be right is one of the greatest psychological traps in trading. It blinds traders, causes them to hold losing positions long after their edge is gone, and leads them to miss opportunities when the market disagrees with their biases. A trader who clings to the need to be right is not trading the market. They are trading their ego. The market punishes ego without mercy. It rewards flexibility, humility, and probabilistic thinking. Probabilistic thinking means recognizing that every trade outcome is uncertain. Even the highest quality setup carries the possibility of loss. No indicator, pattern, or analysis technique can eliminate risk. Instead of seeking certainty, a trader who adopts probability-based thinking focuses on identifying an edge, something that, over a large enough sample of trades, yields a positive expectancy. This is the same logic used in casinos, insurance companies, and statistical modeling. Short-term outcomes are unpredictable, but long-term results follow a distribution. When traders think this way, they stop trying to force individual trades to behave perfectly and instead focus on the bigger picture. A trader who understands probabilities accepts that a loss is not a failure. It is simply one event within a random distribution. Emotional suffering disappears because the trader no longer interprets a losing trade as a personal defeat, but as a normal occurrence. This shift removes the emotional sting that leads to revenge trading, fear-driven hesitation, or abandoning a valid system. Instead, the trader becomes stable, disciplined, and consistent. They follow their plan because they trust the process, not the outcome of any single trade. Another powerful aspect of embracing probabilities is the realization that the market is neutral. It is neither friend nor enemy. It does not favor optimism or pessimism. It merely displays the collective decision-making of all participants. When traders project their beliefs onto the market, such as expecting price to rebound, reverse, or continue, they are attempting to predict behavior based on emotions rather than data. The market owes no explanations. It does not bend to opinions. It simply reveals which side, buyers or sellers, has more conviction at any given moment. A trader who accepts this neutrality becomes far more objective. They interpret price action as information, not as validation or contradiction of their personal views. Objectivity is the gateway to clarity. When traders detach from the desire to be right, they begin to see the market as it is, not as they hope it will be. They stop ignoring warning signs, stop fighting trends, stop holding losers out of hope, and stop exiting winners prematurely because of fear. Instead, they let data guide decisions. They evaluate setups based on statistical performance, not emotional comfort. They understand that their job is not to predict the future, but to exploit repeatable patterns with measurable edges. They also accept that even a perfect edge produces losing trades, and they make peace with that reality. Embracing probabilities also means adopting the mindset of a risk manager rather than a fortune teller. Traders who believe their personal opinions matter often risk too much, over-leverage positions, or widen stops, because they are convinced the market must go their way. This is dangerous thinking. The market must do nothing. Proper risk management becomes natural once a trader accepts that any trade can fail. They size positions appropriately, define risk before entering, and maintain discipline because they know survival is more important than being right. Probabilities demand respect. They require consistency, patience, and adherence to rules. A trader who operates within a probabilistic mindset also understands the importance of sample size. One trade means nothing. 5 trades mean nothing. Even 20 trades mean little in the grand scheme of statistical performance. Judging a strategy, a technique, or one's own abilities based on a small cluster of trades is emotionally driven, not statistically valid. Probabilistic thinkers know that long-term success emerges from hundreds of executions. This perspective protects them from emotional whiplash, from both winning streaks and losing streaks. A series of losses does not make them doubt their edge, and a series of wins does not make them overconfident. They remain balanced, steady, and focused on process rather than outcome. The acceptance of probabilities also reshapes how traders deal with uncertainty. When traders cling to personal beliefs, uncertainty feels threatening. They want the market to move in their expected direction, and when it doesn't, anxiety arises. But when traders embrace probabilities, uncertainty becomes an ally. It becomes the space in which opportunity exists. If outcomes were certain, there would be no risk, but also no reward. Uncertainty is the field on which traders operate. Probability-based thinking transforms fear of the unknown into respect for the game. Another profound shift that occurs when traders embrace probabilities is the diminishing influence of emotional biases. Confirmation bias, anchoring, loss aversion, overconfidence, they all weaken because the trader is not fixated on personal predictions. They are focused on following an edge. They do not seek information that supports their belief. They seek information that reveals high probability setups. They do not anchor on past prices. They respond to current conditions. They do not avoid risk. They manage it appropriately. This evolution in thinking brings traders closer to objectivity and further from emotional sabotage. Probabilistic thinking also cultivates humility. The market humbles everyone, regardless of experience. Even the greatest traders in history endure losses, misreads, and unexpected events. Humility frees traders from the illusion of control. It teaches them to adapt, to grow, and to evolve. It teaches them that survival comes through respect for uncertainty and disciplined execution. Humility opens the door to continuous learning, whereas belief-driven certainty closes that door. With this shift, traders begin to see the market as a dynamic ecosystem, rather than a puzzle to solve. They understand that conditions change, trends form and break, volatility rises and falls, correlations shift, and sentiment evolves. Probabilities shift along with them. A static belief system cannot navigate a dynamic environment, but a probabilistic mindset thrives because it adapts to new information. This adaptability is one of the most powerful traits a trader can develop. Finally, when traders integrate the idea that the market reflects probabilities and not personal beliefs, they enter a state of psychological freedom. They no longer feel the emotional burden of needing to predict. They no longer feel the desperation to force outcomes. They no longer chase perfection or avoid uncertainty. Instead, they act with clarity, patience, and confidence. They understand that their role is not to control the market, but to control themselves. They think in terms of edges, sample sizes, and long-term performance. Losing a trade becomes as normal as breathing. Winning becomes a natural result of disciplined execution. The market becomes a place of opportunity rather than emotional conflict. In the end, the market reflects probabilities, not personal beliefs. This principle liberates traders from illusion and aligns them with reality. When a trader truly adopts this mindset, they stop arguing with the market and start listening to it. They become students of behavior rather than victims of emotion. They build consistency not through prediction, but through disciplined execution. And over time, this mental shift turns trading from an emotional battleground into a structured, manageable process. When traders understand that their beliefs do not move price, they let go of ego, adopt humility, and embrace objectivity. They allow probabilities to guide them, and in doing so, they unlock the foundation of long-term success. The market does not care what anyone thinks, but it consistently rewards those who align with its probabilistic nature. Emotional neutrality is the gateway to peak performance. In trading, this principle is frequently misunderstood, reduced to the idea of suppressing emotion or acting like a robot. But emotional neutrality is not about eliminating emotions. It is about ensuring that emotions do not influence decisions. It is the capacity to engage with the market from a place of clarity, detachment, and mental balance. When emotions dominate the trading process, decisions become reactive and distorted. When neutrality dominates, decisions become deliberate, precise, and aligned with the trader's edge. This state of neutrality is rare, yet it is the common denominator among consistently successful traders. To understand why emotional neutrality is essential, one must first consider the psychological environment of the market. The market is a high-stakes arena filled with uncertainty, risk, and constant fluctuation. It triggers some of the most powerful human emotions: fear, greed, frustration, excitement, and anxiety. These emotions served evolutionary purposes in environments that demanded quick reactions to physical threats. But in trading, emotional reactions often lead to impulsive actions. They override logic, distort perception, and compromise discipline. In an environment where decisions must be based on probability, data, and rule-based execution, emotional noise becomes a barrier to peak performance. The path to emotional neutrality begins with awareness. Awareness means recognizing that emotions are part of human nature and will always arise, but instead of fighting them, the trader learns to observe them without identifying with them. For example, fear may arise before entering a trade, especially after recent losses. A trader lacking neutrality will interpret this fear as a signal to avoid risk, even when the setup is valid. A trader rooted in neutrality will recognize the fear but act according to the plan. Emotions may exist, but they do not dictate behavior. This separation between emotion and action is what defines neutrality. Emotional neutrality also requires a shift in how traders interpret outcomes. Most traders attach personal significance to individual trades. A win creates excitement, confidence, and sometimes overconfidence. A loss creates disappointment, frustration, or self-doubt. These emotional highs and lows produce inconsistency. A trader on an emotional high may take reckless trades. A trader on an emotional low may hesitate or avoid taking trades altogether. Neither extreme leads to peak performance. Neutrality is the middle ground, where the trader remains steady regardless of recent outcomes. Each trade is viewed as a single event within a larger series, not as a reflection of personal worth or competence. This perspective becomes easier to adopt once a trader embraces the probabilistic nature of the market. When the trader understands that outcomes are inherently uncertain, and that even the best setups can fail, they stop assigning emotional value to individual results. They stop seeing a loss as a failure and start seeing it as a normal part of trading. Emotional neutrality thrives in an environment free from over-attachment to outcomes. Peak performance arises when execution is driven by the process, not by emotional reactions to outcomes. Another important element of emotional neutrality is detachment from money. Money is emotionally charged. It represents security, opportunity, status, and even survival. When money is at stake, emotions intensify. Traders who are overly attached to the money involved in a trade experience heightened fear when risking capital and excessive excitement when gaining capital. This attachment leads to micromanaging trades, moving stops, cutting winners prematurely, and letting losers run, all of which destroy long-term performance. Emotional neutrality requires reframing money not as something to protect emotionally, but as a tool used to exploit market opportunities. When traders internalize that money is simply the medium through which probabilities play out, they trade with more composure and confidence. Neutrality also involves letting go of the need for control. Many traders attempt to control outcomes, believing that precise prediction or perfect timing can guarantee success. But the market is not something that can be controlled. It is a living, breathing organism composed of millions of decisions made by participants across the globe. Attempting to control it leads to frustration and emotional chaos. Neutrality emerges when traders accept that they cannot control the market, only their responses to it. This acceptance creates psychological freedom. It removes the emotional tension that arises from unrealistic expectations. When traders focus solely on what they can control, entries, exits, risk, and discipline, their performance improves naturally. A key advantage of emotional neutrality is the ability to see the market clearly. Emotions distort perception. Fear makes danger appear larger than it is. Greed makes opportunities look better than they are. Hope blinds traders to warning signs. Anger pushes traders into revenge trading. When traders learn to quiet these emotional distortions, they see price action more objectively. They notice subtle shifts in momentum, structure, or volatility. They interpret information without bias. They learn to respond to the market rather than react to it. This clarity gives them a significant edge over emotionally driven participants. Neutrality also supports rapid recovery from mistakes. Every trader makes mistakes. Entering too early, exiting too late, violating rules, or misreading a setup. Traders who lack neutrality dwell on mistakes, feel guilt or frustration, and carry emotional residue into future decisions. This emotional baggage compounds and leads to further errors. Traders grounded in neutrality view mistakes analytically. They acknowledge the error, study it, and release it. They move forward unburdened. This resilience is a hallmark of peak performers in all fields, from sports to business to elite military operations. Another profound benefit of emotional neutrality is the consistency it brings to execution. Most traders struggle with consistency not because they lack a good strategy, but because they cannot execute the strategy consistently. Their decisions fluctuate with their emotional state. Neutrality stabilizes execution. It creates a mental environment in which rules are followed without question and without internal conflict. The mind no longer oscillates between extremes. It becomes a calm, disciplined tool. Trade by trade, day by day, neutrality produces steadiness, and steadiness produces results. Achieving emotional neutrality requires internal alignment. You cannot force neutrality through sheer willpower. If underlying beliefs contradict neutrality, emotions will overpower decisions. A trader who secretly believes losses are unacceptable will feel intense fear even if trying to remain neutral. A trader who believes they must predict the market to succeed will feel anxious when uncertain. A trader who believes their worth is tied to their performance will feel devastated by drawdowns. To reach true neutrality, these limiting beliefs must be replaced with beliefs aligned with market reality. Losses are normal, probabilities govern outcomes, and long-term success matters more than short-term fluctuations. When beliefs align with reality, emotions naturally lose their intensity. Neutrality becomes organic. Emotional neutrality also develops through repetition. Each time a trader executes a plan despite emotional discomfort, they reinforce internal trust. Confidence grows. Emotional triggers weaken. Eventually, the mind learns that emotions do not need to dictate action. This process is incremental, but it becomes powerful over time. The more neutral actions a trader takes, the more neutral they become internally. Repetition rewires emotional responses and builds psychological strength. Neutrality also requires a focus on the present moment. Emotional reactions often come from past experiences or future worries. Fear is rooted in the memory of past losses. Anxiety is rooted in concern about future outcomes. Neutrality exists only in the present. When a trader focuses on what the market is doing now, what their plan requires now, and what information is available now, emotional noise decreases. The mind becomes calm and attentive. Decisions become clearer and sharper. This presence is a form of mental discipline that enhances performance dramatically. The pursuit of emotional neutrality is not about becoming emotionless. It is about becoming emotionally mature. Mature traders do not suppress emotions. They understand them, accept them, and move through them without judgment. They create an internal space where emotions can exist without interfering with decisions. This is the hallmark of peak performance psychology. Athletes, surgeons, pilots, and elite performers all cultivate this state. They remain composed under stress, calm under pressure, and focused amid chaos. Trading demands the same internal discipline. Ultimately, emotional neutrality transforms trading from an emotional battlefield into a structured performance craft. It minimizes internal noise, sharpens perception, strengthens discipline, and enhances decision-making. It frees the trader from the destructive cycles of fear and greed, allowing consistent execution of an edge. When neutrality becomes the trader's default state, peak performance emerges naturally. The trader no longer swings between extremes. They no longer chase or hesitate. They no longer react. They respond. They operate from clarity, confidence, and calm. And in this space, the trader finally becomes the one element in the market they can control: themselves. Emotional neutrality is the gateway to peak performance because it aligns the mind with the demands of trading. It removes the emotional interference that destroys consistency and opens the door to disciplined precision. When traders reach this state, they trade with fluidity. They adapt effortlessly. They execute decisions with conviction and release outcomes with ease. The market becomes less threatening, less chaotic, and more navigable. The trader becomes centered, stable, and effective. And it is in this internal stillness, this emotional neutrality, that true mastery is found. In the end, peak trading performance is not built on strategies alone, but on the trader's internal state. When emotional neutrality becomes the foundation, when fear, greed, and doubt no longer control decisions, the trader finally gains access to clarity, consistency, and disciplined execution. This neutrality allows the mind to align with probabilities, follow an edge without hesitation, and remain steady through the inevitable ups and downs of the market. It is the state in which trading stops being an emotional struggle and becomes a professional craft. Emotional neutrality isn't just an advantage. It is the threshold of true mastery.